Hi, Brian C. here from Capital Stewards. President Trump announced his full tariff plan this afternoon. And I'm sure the news this evening will be rife with commentary, some good, some bad, from armchair economists. So I wanted to share some initial perspective with our clients that you can use to inform your thoughts on the tariff action over the next couple of days. So what did the executive order include? I break it down into three parts. The first is a 10% tariff on all goods coming into the United States. Part two is the reciprocal part of the order. That imposes specific tariffs on countries with existing tariffs and trade barriers that the administration deemed were higher than 10%. So examples include a 35% tariff on China, 20% on the EU, 24% on Japan. Notably, Canada and Mexico are left off this list, and U.S. imports that are covered by the USMCA agreement are still tariff-free. So that's a good thing for now. The third part is specific tariffs for autos and metals, which had already been announced last week. Those will be 25%. So think of it as a 10% minimum tariff on everything, higher rates ranging from 20 to 40% on our largest trading partners that have trade barriers, and then specific 25% rates for autos and metals. Is this positive or negative for the economy? In the short term, it's negative. Regardless of your politics, tariffs act like tax. I talked about that earlier this year. We talked about it last year, talked about it several times. They take money from either goods producers or from consumers and they funnel it to the government where it's less productive. Prices also go up. Regardless of the talking points that you hear, the price for goods that were exposed to the tariffs in 2018 during Trump's first term went up. Tariffs raise prices. It happens every time. It's not a matter of what economic camp you're in or what theory you subscribe to. It's just fact. In 2018, the economy was on a more solid growth trajectory. Inflation was moving lower across the board, and the tariffs were more targeted. So the result was the more targeted tariffs didn't overwhelm the other elements of the economy and cause a recession or higher inflation. That does not mean that the story will be the same this time around. Now we have a more widespread tariff regime in a weaker economy with inflation that's already above target. So that's not a good recipe. There's often a debate, I've heard this several times today, where the goods producer or the foreign country is going to eat the cost in the form of lower margins. And there's much debate, like I said, around whether they're going to eat the cost or whether they're going to pass that cost on to consumers. That's called the tariff incidence. Who pays the tariffs matters for analyzing individual companies, but for investors in the broad economy, it really doesn't matter. If consumers pay higher prices, they buy less stuff. That's bad for growth. If foreign companies pay the tariff, their profits are lower and they buy fewer U.S. assets with their extra money. Another talking point I heard earlier today is that foreign countries, they tariff U.S. imports. So isn't this just sort of leveling the playing field? It's true that foreign countries have trade barriers. They have tariffs, they have artificially depreciated currencies, among other things. None of those things are good for the global economy, but introducing more bad doesn't necessarily make it better. Higher U.S. tariffs will make things technically more fair, but that fairness comes at a real cost. So yes, the system could be more fair for everyone, including workers that are in protected industries, but everyone, including those workers, are going to be less wealthy as a result. So the question is whether or not the fairness is worth it. My last point on talking points that I heard earlier today is about bringing jobs back to the U.S. The president mentioned this several times. It's unlikely that tariffs at 20 to 30% are going to impact manufacturing that much. It generally costs less than half of U.S. production costs to manufacture something in Asia. That means to really cause manufacturing to reshore for purely economic reasons, tariffs probably need to be closer to 100%. So this is not directly going to cause a lot of physical reshoring. What's an optimistic view? So it is possible to live in a world that has higher tariffs with lower taxes that offset those tariffs. But those taxes have to be substantially lower across the board from today's levels. Simply extending the tax cuts from Trump's first administration doesn't get the job done. That just leaves things where they are today. That's not stimulus. So eliminating taxes on tips and on Social Security, those things would need to become reality, plus probably additional cuts to truly offset the impact of tariffs. The problem is those won't be felt by consumers until they do their taxes and maybe get a refund in 2026 or 2027. We're in 2025 now. So tariffs start now. So the potential upside is a long way away. My view, perhaps sort of somewhat optimistically, is that over the medium term, the higher tariffs will ultimately be negotiated down. The impact otherwise would be severe recessions in a lot of these foreign countries. The key point is that the 10% seems to be the real bottom line. That was pretty clear in the talking points and in Trump's statement today. So perhaps other countries with higher tariffs can remove their tariffs on US goods and see a reduction in the tariffs down to that 10% level. So on the whole, that could actually be good for the global economy, but that's going to take time. Perhaps if this really is the strategy, the administration could just communicate that more effectively, and then markets probably would be down, but not as much. So what's the market reaction to all of this? The country-specific reciprocal tariffs were higher than the market was anticipating, pretty significantly. So the initial reaction is fairly negative. The S&P is down more than 3%, and the NASDAQ is down more than 4% in after-hours trading. Asian markets have opened up in the last couple of hours, and they're down as well. Diversifying assets like bonds and gold are obviously rallying. That provides some support in portfolios. Our portfolios were conservatively positioned going into today. So we were underweight stocks, overweights in gold and bonds. So we don't really need to change much based on what's happening today. For the year, most portfolios are basically flat as that diversification bucket of assets, chiefly gold and bonds, have offset broader equity market losses so far this year. So all of this goes to show that diversification is really important given all volatility. It helps protect portfolios from significant downward movements in the market when those things happen. Lastly, even if we see more downside in a recession, we plan for this. When we build financial plans and portfolios, we have all those negative scenarios in there for a reason. So your plan can withstand kind of these bumps along the way. So that's all for tonight. I wanted to just provide a short update on my thoughts. The full outlook for the second quarter and performance will be out in the next week or so. So look for that in your inbox. Have a good evening.